You know, banks are absolutely crucial to our financial system. It's like they're the heart, and credit is the lifeblood that they pump through the system. Without banks, it would be really difficult for lenders to connect with individuals and corporations that need financing. We rely on banks to hold deposits for both institutional and retail clients, and to fund the economy so that it can continue to grow. But I can't shake this feeling of anxiety. It's important to remember that banks are not infallible, and just like any other institutions, they are capable of failing. And this is exactly what's happening right now. We are currently witnessing the horrifying downfall of America's banks. So I think we really need to understand the danger we're in right now. That's why make sure to stick to the end of this video and start thinking now. With that said, let's start. Did you know that over 550 banks have collapsed since 2001, according to the FDIC? It's worrying to think that the first year in American history where not a single bank failed was 2005. Before that, at least one bank had failed every year. It's cyclical, and we have good times where the economy is stable and no failures occur, but we also have periods of recession and financial stress where failures spike. Recently, the collapse of Silicon Valley Bank, Signature Bank and Credit Suisse were a harsh reminder of how quickly a trusted institution could fail, putting billions of dollars at risk. It's the largest bank meltdown since the Great Recession more than a decade ago. So what causes a bank to fail, and what are the implications for the US economy? It's important that we address these questions and ensure that our banking system remains strong and stable. Let me tell you about the three main risk factors that can cause banks to collapse. The first one is credit risk, which happens when banks make loans and are exposed to defaults from the people they lend money to. The second is interest rate risk, which is when a bank's assets and liabilities have different interest rate profiles and the bank tries to minimize this risk. And the third is liquidity risk, which is when a bank doesn't have enough money to meet its short-term financial obligations. If any of these factors become too much for a bank to handle, it can lead to a crisis of liquidity or solvency, which means the bank might fail to meet its long-term financial obligations or cover its liabilities with its total assets. This is really scary because if a bank has too many bad loans and is not able to collect the money it's owed, it can't pay back its depositors. And if enough people try to withdraw their money at the same time, it can cause a run on the bank, which is what happened to SVB, the second largest bank to fail in American history. It's really important for banks to manage these risks and make sure they have enough money to cover their obligations. But it's also important for us as consumers to be aware of these risks and make sure that we're not putting our money in a bank that's too risky. I remember back in 2008, during the recession, a lot of people were getting mortgages they couldn't afford, and it caused many banks to fail. We don't want that to happen again, so we need to be careful where we put our money because we need to make sure that we're working with reputable institutions. If a bank fails, the Federal Deposit Insurance Corporation steps in, but there's no guarantee that everything will go smoothly. The FDIC was created in 1933 to protect depositors and improve trust in the American banking system, but now it seems like they're constantly having to handle these types of situations. For most banks, the FDIC tries to sell the failed bank in whole or in part to another bank that's doing well. The new bank takes over the loans and deposits, but sometimes the FDIC has to put money into the deal to make it more attractive for the acquiring bank. In other cases, the FDIC has to take a more hands-on approach, like what they did with Silicon Valley Bank, where they took possession of the bank and created a bridge bank to get depositors their money and then liquidate the bank. It's good to know that depositors in FDIC-insured banks are covered up to $250,000 per depositor per bank for each account ownership category, but not all banks are FDIC-insured. And now with the government's recent announcement that even uninsured depositors of SVB will continue to have access to their money, it's setting a worrying precedent. This could mean that unlimited government support is there for every dollar in the banking system, and it's not clear how that would be sustainable in the long run. We need to address the issue in a comprehensive way by possibly raising the deposit insurance limits and having the deposit insurance premiums reflect that accordingly. The government needs to take swift action to contain bank failures that could lead to a domino effect. We've seen in the past that the quicker we move to isolate the incident from other banks, the less likely it is to spread. And unfortunately, there's always the potential for dominoes to fall, triggered by something like an oil crisis, a farm crisis, or a housing market crash. I really worry about the impact of bank failures in the American economy. Just think back to the financial crisis of 2008 and the failure of those financial institutions. It had a massive impact on the economy, greatly restricting and constricting it. You see, banks have to be careful with their capital, so they tighten their lending standards to conserve it. But as they do that, there's less credit flowing through the economy. This contraction of credit can have a negative impact on economic growth and could even trigger economic slowdowns or recessions. It's a scary thought. And while we might wonder if there are enough regulations to prevent and buffer against bank failures, experts say that's not the right question to ask. The more fundamental question is whether we're enforcing the rules properly, and unfortunately the answer to that is no. In fact, regulators were warning as recently as 2019 that things needed to change at Silicon Valley Bank and potentially others. There were failures of supervision by the Federal Reserve that were obvious and rampant. It's really worrying to think about the potential consequences of this. Some politicians and researchers are saying that one of the main reasons for this failure is the deregulation that happened under Dodd-Frank. You know, they rolled back some of the regulations and it seems like they made things worse. It's really concerning because we need to make sure that our banks can handle tough situations, and that's why the Federal Reserve started doing these stress tests, where they simulate different scenarios to see how the bank would fare. It was really helpful, but then the Trump administration came along and started calling for even more deregulation. It's just frustrating because Dodd-Frank was such important legislation, and now it feels like we're taking steps backwards. Congress did manage to raise the limit for the banks subject to scrutiny, but it still was not enough to save the SVB. They were in that range between 50 billion and 250 billion, so when the limit was raised to 250 billion, they were no longer under the same level of scrutiny. I don't know, it just feels like we need to be doing more to protect our financial system. This is really an important issue, and I hope the Congress will take it seriously, even with the election coming up. Deregulation has been tried before, and it has not worked out. I mean, we keep failing, so why do we keep doing it? It's like we're playing a dangerous game with ourselves. I know that panicking won't help anyone, especially after a bank collapses, but we can't just ignore the lessons that we can learn from it. Although overall the banking system in the US seems to be safe and sound, it doesn't hurt to be cautious. I think we should all take a look at the financial health of our own banks and financial institutions. If you happen to have more money than the insured amount, then it might be a good idea to spread it out to different banks just for your own peace of mind. Especially if you're banking with a small community bank. While it's unlikely that something will happen to it, if it does, it's unlikely that the regulators will guarantee all of your deposits. They would only guarantee up to $250,000. It's clear that without banks, our financial system would be unable to function properly, and it will be difficult for individuals and corporations to access the financing they need. With that, we've come to the end of this video. Thank you for watching. If you found this video informative, please give it a thumbs up and consider subscribing to our channel for more content like this. Also, feel free to leave a comment below with your thoughts on this topic or any questions that you may have. And remember, if you're interested in learning more about finance and the economy, be sure to check out our other videos on this channel. Thanks again for watching, and we'll see you in the next video. Until then, peace.